Welcome back to my channel, and today we are going to explore the two most famous and very good large cap funds. According to me, this is not a promotional video, this is just for educational purpose so that I can teach you how to find a good large cap fund. We have two good large cap funds in front of us. One is the ICICI Prudential Large Cap Fund, and another one is the Nippon India Large Cap Fund. As we can see, both are equity large cap funds and both have almost similar track record, 18 years and almost 19 years. So it's a very good track record. Both the AUM is also very large, like 75,000 plus crore and 51,000 plus crore. So very good AUM, very good AMCs as well. As we know, Nippon India and ICICI Prudential are good AMCs. We should not see the returns of 3 months or 6 months or 1 year because in the recent times the market have gone very down and our Nifty and Sensex and everything is low. So yeah, the large cap returns will be low. But in the long run period of 3 year or 5 year, as we can see, Nippon India stands out than ICICI Prudential in the 3 year and 5 year. So and it in the 1 year also it has lower negative returns. So it is a good thing as we can see in the 6 months and the 3 months too. That means Nippon India is according to, as we can see, the returns, it is good. Now let's see the other parameters as well. This is the standard deviation. Standard deviation means according to the fund's return, how much it fluctuates. Okay, so Nippon India fluctuates more, but it has delivered much more returns than in 3 months to 5 year period. Okay, and this 2% gap may feel very low, but when we compound it for years and years, like 10, 15, 20 years, it will be huge. Okay, it is not advisory that to buy, I mean, to do SIP or lump sum in Nippon India, not in ICICI Prudential. Just I am uh, explaining you, okay? And as we have discussed in the previous all videos, standard deviation should be the lowest is good, and all four ratios, Sharpe, beta, Sortino, and alpha should be the maximum. Beta ratio is almost equal. In beta, a slight edge to Nippon India. In Sortino, slight edge to ICICI Prudential. And in alpha, slight Nippon India is better. That means both are almost similar on all the four things. In one or two, ICICI Prudential is better, and in other two, the Nippon India is better. So there is not much huge difference. Okay, the difference is in the standard deviation, that is zero point 0.5. That is also very less. But due to its comparatively lower AUM, Nippon India can enter and exit any stock at any point of time they want easily as compared to the ICICI Prudential. Because even in the 1% of this AUM is 516 crores. Okay, so in any company, if they want to buy or sell 516 crores worth of shares, it is easier for Nippon India rather than ICICI Prudential. These are the some top sectors they are invested in and the top stocks that we don't need much right now. In equity, 94% almost ICICI Prudential is invested and 1% almost in debt. So we can consider that rest is 4 to 5% they have in cash to buy right now. While Nippon India is also a similar story, but they don't have anything in debt. They have 96.4% invested and between 3 to 4% they have cash in hand to buy in the current dip. Okay. And all other things we will see from the coin Zerodha and yeah, see, these are the fund managers, and I am not advertising any of these like websites like ET Money or Coin but I just use them. So I am just telling you it's a good thing, okay? Its expense ratio is we have the less is better. It is 1.11 for this Nippon India and 1.2 for ICICI Prudential. 1.11 and 1.2.1% may not look huge, but in the monthly SIP for 15 to 20 years, it will be huge. Let's see, in 1 year it is minus 2.42. In 2 years is plus 4.46. In 3 years is 14. Now let's see for the ICICI Prudential one. Exit load is same for both. Okay, and AUM as well. This is more negative in last 1 year than Nippon. Again, lower returns than Nippon in 2 years. In 3 year also lower returns than Nippon. Let's see for 4 and 5 years. On a long run, 15% returns. Almost anyone can assume like for 7, 10 years. Okay, it is also lower, and this is also lower as compared to Nippon. So yeah, and Nippon is also a bit we can say less just expensive. It is not a buy recommendation again. Let me tell you, we also should see the rolling returns and the fund managers and everything. Here on the Google, I have searched for the rolling returns. Let's see what they are telling that both are very excellent consistency, but ICICI Prudential shows slightly stronger downside product. What is downside protection? Downside protection means when the market moves down, all the stocks moves down, but the ICICI Prudential selects stocks in such a way that it moves less downwards and maybe less upwards too, because of its strategy, right? Nippon India's rolling returns, that is not point to point return, day to day 5 year period returns since its inception is 16.95%. It is considered very good. Okay. And 16.73 for ICICI Prudential. As we discussed, not much difference in the returns, but just the expense ratio of this is lower and a bit 0.2% higher return in the 5 year period. Let's see for the 3 year period too. For 3 year period, Nippon's rolling return is 17.14 and it is 15.28. So in the last 3 years, 2% gap and the 0.1% gap in the expense ratio is also there. So according to me, Nippon India is the winner. Comment down below. What do you feel about it?